are going to introduce the last set of reversal patterns we are going to cover. Wedges can be rising or falling. Both types can also be either continuation or reversal patterns, depending on the preceding trend.
So quite a range then. I presume the confirmation is the important part.
That's right. To begin with, let's look at rising wedges. These are considered bearish patterns.
Okay, so how do rising wedges form then?
In order to be valid as a wedge pattern, there needs to be a prior up or down trend, the most common being the latter.
So that's when it's a continuation pattern, right? After confirmation, the price is continuing down.
Yes, it takes at least 2 highs to form the upper resistance line, ideally 3. Each new high should be higher than the previous high.
I get that.
At least 2 lows are required to form the lower support line. Each low should be higher than the previous low.
Okay, so it looks like a door wedge and it's sloping up.
Yes, it's a rising wedge. The price is contracting. The upper resistance line and the lower support line converge as the pattern matures. Every time the bulls push back and move the price up, it becomes less and less convincing.
In what way does it make it less convincing?
Well, the upper resistance line fails to keep pace with the slope of the lower support line and indicates a supply overhang as prices increase. This places a time limit on the pattern, which traders like.
Ah, okay. What next?
Finally comes the all-important confirmation. This comes when the price breaks the support line. The price might return to retest the old support line, now resistance. Falling wedges are bullish patterns. Like rising wedges, the preceding trend can either be bullish or bearish. A falling wedge forms an upper resistance line. It takes at least 2 highs to form the upper resistance, but ideally 3. Each high should be lower than the previous highs.
Okay.
At least 2 lows are required to form the lower support line, and each low should be lower than the previous lows.
I'm with you so far.
The falling wedge is developing in a contraction. The upper resistance line and lower support line converge to form a cone as the pattern matures. These new lows still fall past the previous lows, but it's becoming shallower. These new lows indicate a decrease in selling pressure and create a lower support line with less negative slope than the upper resistance line.
That makes sense. It makes a falling wedge shape.
Finally, the falling wedge is confirmed when there is a resistance break. A bullish confirmation doesn't come until the resistance line is broken convincingly. It's sometimes beneficial for traders to wait for a break above the previous high for further confirmation. As with rising wedge, once the resistance is broken, the price can sometimes return to retest the newfound support level.
Thanks for explaining those patterns. How would a trader trade them?
Okay, let's look at how a trader would trade a rising wedge on a chart. Here is one I've already identified on dollar-yen. Both support and resistance lines slope up and the price is coming together. Wedges can be one of the most difficult chart patterns to accurately recognize and trade.
What makes it difficult to recognize?
While it's a consolidation formation, the loss of upside momentum on each successive high might suggest the bulls are losing steam. However, the series of higher highs and higher lows means not all trend indicators point to a downside trade.
Okay, I think I'm following. The other indicators, like looking at all 3 moving averages, are not all pointing to going short.
Correct. The final break of support indicates that the bears are finally on top and lower prices are likely.
Okay, so we'd be looking for a break in support then?
That's right. Unlike all the other patterns we've seen, there are no measuring techniques to estimate the decline, so other aspects of technical analysis should be employed to forecast price targets.
I presume all the other factors like duration and volatility play a part in determining its significance.
They sure do. This pattern is not particularly long in duration or height.
Okay, so although this is a rising wedge, it could be more significant.
Trading is a probabilities game. There are seldom times where everything is perfect. Let's find a falling wedge. Let's have a look at a falling wedge. This is the Euro-Aussie dollar pair back in 2014. This falling wedge is a really long-term pattern. It forms in an uptrend. It's coiling in with support and resistance being tested several times each. Finally, it fakes out below support only to return into the wedge. This is enough for the bulls and it rapidly pushes above resistance, confirming the pattern and carries on in an upward trend.